Chris White is BondCliq CEO, and it's good to see you, Chris.
Good to see you too, Adam. Happy Juneteenth.
Thank you very much, and a happy Juneteenth to you as well. One of the key questions that you've suggested we explore is what at least the expected impact of direct Fed purchases on corporate bonds has been, especially with the 10-year. I just checked, I believe the 10-year is barely above 0.7%, the yield. So what is the impact on the corporates?
Well, I think that this is something that your audience really needs to pay attention to, because what the Fed has done traditionally has been direct bond buying in areas of the market that really don't have a direct impact on their portfolio. So right now, the Fed is purchasing about $120 billion a month in combined Treasury and mortgage-backed bond purchases. But as you know, starting in March, the Fed announced that they would be purchasing corporate debt. And the reason why this has an impact on the portfolio of an individual is because many of these corporations, whether you're owning their corporate debt or owning stock in that corporation, it's going to be impacted as to whether or not the Fed chooses to help ease the lending of those or the borrowing of those corporations by buying their debt. And we're talking about a massive amount of money here, Adam. I mean, the Fed is throwing billions into the corporate bond market in order to stabilize it.
Chris, it's truly good to see you. Obviously, it has implications for people who have bonds in their portfolios as well, as many people do, even if they don't directly know about it, right, through things like mutual funds. You know, the adage has always been, don't fight the Fed. That has mostly, in the past several years, applied to equities and just asset inflation generally. How does it apply to bonds specifically if you're a corporate bond investor? Do you sort of follow the Fed and what they're investing, or what are those implications?
Yeah, that's a great question. I think the Fed has been putting their foot on the gas pedal for so long in terms of easing access to credit that it's really hard to be able to trade using fundamental analysis, because the value of corporate bonds is now not being pegged to whether or not the corporation itself is going to be able to pay off their obligation. The value of corporate bonds is now being pegged to whether or not the Fed is going to support the company. And that's why it's really important to pay attention to what the Fed is saying, to stay on top of changes they have to this massive policy that has very little details around direct bond buying, because they're constantly switching what they're saying. For example, on Monday, the Fed made an announcement that they were adding a third category to what they will be able to purchase in the corporate bond market. The first two original categories were individual corporate bonds and ETFs. And around individual corporate bonds, they were restricted by the CARES Act by only investing or buying corporate bonds for corporations that had their workforce domiciled in the U.S. And you can understand that, Julie. What they're trying to do is make sure that those companies don't cut a lot of the U.S. workers, and that's really the purpose of the program. But what the Fed introduced on Monday was the idea that they could actually start buying something called bond index eligible bonds or index eligible bonds. And what that effectively does is it expands the universe of corporate bonds beyond the bonds that were just identified as being eligible according to the CARES Act. So now there are companies that do not have their labor forces domiciled in the U.S. that are now going to be bailed out by the Fed in terms of this direct bond buying program.
Chris, we could have a whole half-hour discussion about this, but I'm curious, when other guests have been on and we ask them about some of the issues that you just raised, they kind of say, well, look, the ETF purchases so far are roughly, about $5 billion. And you, I think, have pointed out that only $500 million is earmarked for corporate bond purchases. They almost dismiss it on a balance sheet of $7 trillion. It's nothing to pay attention to. What are they missing? What are we missing?
I think what we're really missing is look what happened on Monday. On Monday, the market was down about 700 points at some point in time. Am I correct? I mean, I'm a bond guy. I don't really watch the equity markets as closely. But as soon as the Fed said that they were going to start purchasing corporate bonds, because up until this point, the Fed hasn't bought a corporate bond, they've bought ETFs. As soon as the Fed said that, the market flipped around. And I think we ended up on the day up about 157 points. So it's actually interesting. It's sort of almost like U.S. foreign policy was 30 or 40 years ago. Speak softly, but carry a big stick. Like the Fed is sort of speaking softly about what their intentions are. in terms of purchasing corporate debt, but the reaction of the markets, especially in the equity market, seems to be immediate and it seems to be profound. What do you think would happen, for example, Adam and Julie, if on Monday the Fed said, you know what, we're going to stop all these corporate bond purchases? If it's such a small thing, then I think that we all would just expect the equity markets not to react. I bet you the equity markets would have a severe reaction if the Fed said that they were going to stop doing this. So it's not really the amount, it's really the intention of the Fed.